Hi, thanks for joining my market report. My name is Mike, and my market report is on mortgage rates. If you haven't followed my videos before or my channel, well, we come out with these videos on a daily basis and give you the information on what's impacting mortgage rates on those days. It could be sometimes from headline news to economic data it's reported to sometimes geopolitical or sometimes the sentiment in the markets that are out there. Now, sometimes when you're on the sidelines, we get some good news that you think would be great for bonds, which are what drives mortgage rates. Uh, but sometimes they react negatively, and we're here to kind of get into explaining that data for you as to why maybe sometimes good news is bad news in the markets. So, a little bit about myself is I am a loan officer. I work with a national lender, so we do loans in all 50 states. We're here to help you guys out with your refinance or your purchase deals. If you guys are looking to buy or even look to refinance, we're also here to act as a source for you folks. If you guys got questions about programs available out there or mortgage rates or whatnot, please feel free to reach out to us. We're here to help you guys with your act as a source for you folks as well. So we're here to help you guys out. Without further ado, we'll jump right into the economic calendar for today. We do got some inflation data today, but we'll start off with what we get every Thursday is the jobless claims. And last week's report came out 207,000 people applying for first-time benefits. Forecast came in at 200 for this week, however, it exceeded that by quite a bit to 230,000. Now, we could expect quite a bit of a higher people applying for unemployment again because a lot of times we have the holidays and we get seasonal employees that come in and help out with retail and seasonal, and then around and when the holidays are finished, they're let go and then they go apply for unemployment. So sometimes we see usually a spike in January in terms of. So this isn't unusual that we'll see a greater spike on jobless claims for unemployment. Now, if you look at here's the inflation data. We got inflation on the wholesale side of things. Now, it doesn't always get respect, but it's something we do like to keep our eyes on because at some point, if it stays too long or too high, it does get passed on to the consumer, but not all the time. This is why it kind of doesn't always have the respect out there. Now, we'll start off with the headline Producer Price Index. In It was the previous month, back in November, it was raised from initially came out at 0.8%, but it was revised higher to 1%. Forecast was coming for 0.4% for the month of December, and it only came in at 0.2%. So, not a big deal right there. Now, when you strip out food and energy, we get what they call the core PPI, and it's also it rose. It's back in November, it was 0.7 initially, but it rose to 0.9%. Forecast called for 5%, point half a percent, and it came in at half a percent. Now, its year over year went from 7.7%, was revised higher to 7.9% in November. Forecast come for 8%, and it came in at 8.3%. So that's obviously a very big number. We've been seeing these numbers. These are like 40-year numbers. So we had the CPI come in yesterday, which was the highest we've seen since 1982. And again, we're still seeing very high inflation. So these are the big things that are in the investors' minds are out there on inflation. We just had Lael Brainerd give her testimony because she's going to be the number two person behind Jerome Powell in the Fed, with the Fed, and she's always been kind of known of more of a dovish, but she is speaking a lot more hawkish about attacking the inflation data. But she also wants to be tied towards jobs, and they don't want to go ahead and be overboard on fighting inflation and forget about jobs. So that's going to be a big thing for them as well. Uh, Again, we've been kind of talking about quite a bit. This is some of the things that they're working towards. The Fed working to try to contain it. We do know that some of it might be transitory, even though they've been. We're not seeing it yet, but it's going to take some time. Some people are projecting that it could take maybe about halfway through the year, maybe in June, until we see some openings in there. Omicron, of course, threw some wrench in there, slow things down a little bit, where a lot of places got kind of closed down a little bit, or slow things down with the supply chain. We're also having labor shortages in a lot of areas as well. So these are a lot of things that are kind of what's driving the supply chain and what's creating the transitory. So you got a lot of demand, but now you get the supply, which is just raising the inflation. Now, some things won't be transitory. One thing you don't usually see is people's paychecks going down. salaries. So that will be something that will probably remain high. But you got inflated prices on autos and stuff like that. And of course, with the higher rates, home prices at that point will slow down as well. They won't be spiking to double digits that we've been seeing over the last year or two. And that will slow down a little bit too. It doesn't mean that they're going to go down in price. It just means that they're not going to go up as much as they've been going. So those will slow down a little bit with the higher rates as well over time. Now, to kind of move on, we also have the 30-year bond auction, which didn't get much. It did okay, basically. It came out just about an hour ago, and it did okay, not great, but it didn't really affect the markets too much. So it's kind of playing its way through. So let's go ahead and take a look here at the mortgage-backed securities and see what we did over here. So right now, this is going, wow, you can see it back and forth. So it was just up about 6 basis points and just dropped down to negative 0.5. So, but here's the volatility as we're seeing right now. We said go upwards as soon as we go upwards, and then we dropped. And then as soon as some of the data was released, it kind of came upwards, and then and then we saw another drop, and then we saw rise upwards again. And just this last second, as you saw, it just dropped down 6 basis points now for the day. So a lot of volatility today. Markets are trying to decide, a lot of uncertainty of where they want to be because there's still little questions out there regards to the Fed's actions. They said the dot plot about 3 rate hikes, but more people, I think they're going to be more aggressive and probably come out with closer to 4 rate hikes this year as well as 4 next year. So again, they're still trying to get some clarity on where things are going to go and how aggressive. If Fed's also going to be trying to sell off on their instead of just being passively trying to get rid of their lowering their balance sheets, if they're going to try actually sell off, and that could create a lot more supply out there where there's just not enough demand to meet it. So again, as you can see this chart, it's still volatile. See how it's just -5 now, dropped 1 to 3 to 5. So this is the volatility we're seeing today in the market. Treasuries, they did spike up to almost earlier, top pushing up at 1.75 earlier. Now we're just down to about 1.72. So we're in a better range right now, thankfully, and that adds less pressure on mortgage-backed securities. But the thing is, we want to try to push underneath. If we can get underneath this 1.7 range, that will help us out tremendously and help us more with this correction, bring us back closer to the 25-day moving average on there as well. So one last thing, so we'll take a look at the average conforming limits. They do have points built in, just FYI. And of course, rates don't always have a one-size-fits-all. So we'll start with the 30-year fix at 3.57 and the 15-year at 2.85% right there. So if you guys got questions, again, please feel free to reach out. Probably tomorrow, some of the things to look forward to is there'll be the first reports of the earnings reports for the fourth quarter. So that could help create some normalization in the markets with the earnings reports. And usually we get those with the big banks coming, people like JP Morgan, Chase, people like that will be coming out with their first glimpse of the earnings reports. So there'll be some that will get hit hard, like retail probably with Omicron and some of these during the holidays that kind of hit them. But however, we'll start getting the earnings reports starting tomorrow. So that might kind of affect things in a different manner versus just looking at the economic calendar coming forward. So again, appreciate you guys watching our videos. If you guys like these videos, please smash that like button. Help us out. We greatly appreciate it. And share us. Meanwhile, if you guys got questions, please reach out. We're here to answer any questions we can help you guys out with and help you obtain what you're looking for. And thanks so much. We'll look forward to see you guys in tomorrow's video. Have a great rest of your day. Bye-bye.